Welcome back. I hope you're ready for our final session of the day, Expanding Credit, with thanks to our panel sponsor, Citi. Wow, this will close our first day of the summit. Don't worry, we have another amazing afternoon of programming lined up for you tomorrow. Please note, program tomorrow will begin at 1 p.m. Eastern Standard Time. We are excited to get this panel started shortly, but first, a reminder, attendees, you will see a chat box and a Q&A box both directly to the right of this live stream video. Use them to communicate with other attendees and to send the questions to consideration by our moderator. If you are having technical difficulties, check out our FAQs up top for how to get support or click on the red icon in the lower right corner. With that out the way, let's get this session started. Thank you.
Good afternoon, everyone. Thank you for joining this panel discussion on expanding credit. My name is Brian Loeb. I'm with the Federal Home Loan Bank of New York. We're interested in this panel, not just because expanding credit is a good thing in its own right. It's because it's part of, I guess you could call it like a logical chain, right? It's good if it allows people to access homeownership or entrepreneurship, and then wealth building opportunities or other ways to change their life circumstances to have an effect on their economic mobility. And accessing credit can be the beginning of that chain. The home loan banks, there are 11 of us around the country. We are membership cooperatives of the financial institutions located in our district. And the New York district includes the banks, credit unions, CDFIs, and insurance companies located in New York, New Jersey, Puerto Rico, and the Virgin Islands. And our members are lenders in these areas. And so I thought this panel would be especially interesting to them, to our member financial institutions, to hear what's kind of on the cutting edge in terms of getting more folks involved in improving their economic mobility through accessing credit. It would introduce our members to more organizations that are doing this kind of cutting edge work. So I'm really excited for the panel we have today and for our panelists. I'm going to ask them to introduce themselves. We have Charu Singh, Caren Johnson, Darrelle Forde, and Derek Griggs. And I'd love for them to tell you a bit about themselves, their organizations, and give us a bit of a preview about what they want to share with you today around the topic of expanding credit. So first, I'd like to introduce Charu Singh. She's from an organization called Just Value.
Hi, everyone. My name is Charu Singh. My background is in real estate, in development in the private and public sectors, and for over the past decade, private equity. I'm the founder of Just Value, which is a startup created to find a solution for chronic community-wide home undervaluation in neighborhoods of color. Our mission is to not only discover a more equitable approach to appraisal, but to scaffold a market correction through offering transparency, knowledge transfer, and financial scaffolding to help homeowners access the full equitable value of their homes. It's a pleasure to be here, and I don't always sound this way, but hopefully I'm still understandable.
Thanks, Charu. Caren, why don't you introduce yourself?
Thanks so much, Brian. I am Caren Johnson. I'm the Deputy Director of Digital Products at the Center for New York City Neighborhood. The reason why I'm included in this panel is we're currently working on a system called Underwriting for Good, which is a system that is going to work with existing platforms such as Desktop Underwriter or Loan Prospector in automating the gathering of a borrower's financial data. And what we're hoping to do is sweep this data into the decisioning process sooner and in a way that makes it understandable and automatable for the underwriter as well as the mortgage insurance people on the back end. So passing it back to you, Brian.
Thanks so much, Caren. How about Darrelle? You want to tell us a bit about yourself?
Yes, hi. I am Darrelle Forde, and I'm the Senior Vice President of the SONYMA Single Family Program. And SONYMA, as most of you may know, is the State of New York mortgage agency. We offer mortgage products for first-time homebuyers through partner lending organizations throughout the state, whether they're banks, CDFIs, and we just try to create opportunity and credit for those who may not find it in the private sector ordinarily.
That's great, Darrelle. Thanks. We're already starting to hear a big range, a lot of diversity in the types of organizations represented on today's panel and how they either are directly consumer facing or kind of back of the shop with their hands in all the data, and that kind of trend continues. We'll turn to a fourth area of this universe, and that's Derek. Can you go ahead and introduce yourself?
Derek Griggs, I'm the CEO for Neighborhood Housing Services of New York City. We are a CDFI, Community Development Financial Institution. We're based in New York. We serve all 5 boroughs. I'm here because we are launching a very innovative product that is literally created just to expand access to credit. So we're creating the Open Access Fund that will allow for debt to income ratio up to 50% versus traditional 43% when you get with banks. We also will look at factors other than your credit score, so rental history we'll consider for the mortgage decision. And so just for a factor of dollar amount, what that means, based on 2022 HPD's area median income for a family of 4, this means by expanding your debt to income from 43% up to 50%, you can afford a house $220,000 more than what you can traditionally afford. So it may not sound like a big difference, 43% to 50%, but it's a huge difference in a home that you can afford. Obviously, that's critical with interest rates going up. So glad to be here. Thank you.
Thanks, Derek, and thanks, everyone. Why don't we start with you, Derek, since you started talking about a new program and product that your organization is launching. Can you give us a sense, just like in today's landscape, the individuals and households that your organization serves, what's their relationship to credit? Have they borrowed? Have they tried to apply for a mortgage before? Has their credit worthiness not been satisfactory for traditional lending products? Where is the community today that you're trying to serve, and what's the real need for the product you're describing?
So right now, just about 80% of our clients identify as minority. So the vast majority of all of our client base identify as minority. That's been the case from the beginning. This is our 40th year. So we started because we wanted to impact the historically underserved communities in those districts that were redlined, right? And so we're dealing with that issue over the last 40 years, and unfortunately, it hasn't changed much, right? Since the need for our open access loan fund. We see clients, traditional banks, New York City co-ops are huge relative to the rest of the U.S. And so a lot of the traditional banks won't lend in the co-op space because of the ownership structure. And it's essentially problematic when the co-op may not be in the best financial position, et cetera. Us as a nonprofit, we have a lot more leeway in the underwriting guidelines, and we literally created to serve the community. And so we're willing to take on a bit more risk than traditional banks, whether it's for a not pristine co-op or a client who may have been in a place for 4 years with no rental issues, but their credit score may be bad. Or had some credit issue or thing in the past. So because we do the underwriting in-house, we have the ability to create products and services for our clients. We all know it's been a difficult time with COVID. And so prior to our open access fund, we created a debt consolidation and rehab product. So we allow someone to rehab their house and fold in their debt. So instead of paying your credit card rates at 29%, you can get a rehab your home at 6%. And so our nimble and flexibility allow us to create products that's based on the needs of our clients, and that's what we've always done.
Thanks so much. I want to turn to Darrelle. She's also in the lending space. Can you talk about SONYMA's efforts in this area? How are you either directly or through lenders trying to broaden folks' access to credit? Tell us a bit about SONYMA.
Yeah, so, SONYMA's general programs, all our programs, has no minimum credit score, right? So right off the bat, our programs perhaps are outside the box of what you would find in standard credit programs. But one of the ways that we have tried to expand credit most recently is a new pilot program called Give Us Credit. It's been around for about 2 years. And what we did is we took a look at how traditional credit models were perhaps not capturing responsible financial behavior that should be factored into the credit decision. And so we examined rejection rates across mortgages with our lending partners, and found that households of color were being rejected at twice the rate of white households, even when adjusting for income, right? So households with the same income. And we drilled down into what were the reasons for those, and found that if you expanded your credit decision making by accounting for sound financial management, like paying your rent on time, or for those populations who are unbanked that may pay things in cash and not utilize credit. Often immigrant communities, they don't utilize the banking structure in the way that others do, and so their financial management is not captured. And we have rolled out the Give Us Credit program through our lending partners to allow them to offer mortgage products and let SONYMA assume that risk, right? So no minimum credit score, reevaluating how we determine responsible credit has allowed much more people to qualify for a home, even, touching upon what Derek mentioned, their ratios, because if we can factor in sound financial management, also include income that isn't being reported in the same way as your traditional W-2, right? Many communities rely more on gig income, right? And so we count that a little further, and that will also change your ratios. We also allow for greater collaboration in terms of family and gifting, right? Some, today's families don't necessarily look like the traditional nuclear family. So we have greater latitude with gifts of equity for the transfer of generational wealth from older family members to younger family members. And we've rolled out all of those credit expansion guidelines through this Give Us Credit program that allows our lending partners to offer that program and allow SONYMA to take on any risk that they might ordinarily hesitate. What's been great about the program is that as we've expanded guidelines, it's caused our lending partners to reevaluate their own lending guidelines outside of the SONYMA product. So what's been really encouraging is that our lenders have changed some of their own guidelines, seeing the success or the ways that SONYMA has expanding it and saying maybe they'll take a greater risk. So that's one of the key ways that we are looking to expand credit. But even outside of that pilot program, SONYMA's mortgage products generally sort of push the envelope in lots of ways that standard credit decision making does not.
That's great. Thank you. I want to turn to Charu, and your organization deals with the appraisals side, which is important in a purchase decision, but it's also important in a wealth building setting. And I really love to hear about how you're using data to change the paradigm on appraisals, and how that might improve families' outcomes at those 2 points in their lives.
Thanks, Brian. I'm really inspired by Derek and Darrelle's work, because they're describing a level of flexibility and I think, scrutiny to what we consider to be a risk in a way that really has the opportunity to expand equity within our real estate system. And that really is Just Value's goal as well, to look differently at risk and to expand but technically the methodology and the sources of data in order to identify value for homes and communities of color. There's been a lot of news. I'm sure everyone here has heard at least one story of undervaluation of a home owned by a person of color. And these are heartbreaking to listen to. And so we focus a lot on the subjectivity of appraisers, and really almost weekly, I read a story about how subjectivity has reduced the value of a home. But one thing we talk less about, probably because it's a lot less tangible and frankly interesting, is methodology. I love, Darrelle, that you're talking about the nuts and bolts of your work, like expanding the amount of gift of equity that a family member can extend to a buyer, and that's really what changes the system for expanding equity or credit. Just Value is trying to do exactly the same thing, but really looking at expanding our methodology for appraisal. The appraisal methodology we use today for residential homes is probably pretty similar to what we used about a century ago. But the other thing that's pretty similar are our neighborhoods, actually. So in my own analysis, when we look at what drives value, what impacts value, we found that redlined communities, looking at the historic redlining of a community, is almost coincident with majority of color communities, which is to say that the segregation that started over about 100 years ago remains with us today. And that data set that those policies created and a suite of other policies lives within our data set today. And so what we really propose is that you need to use modern mathematics, which we see in automated valuation models. Everybody has access to Zillow to check out what their building is worth, to go shopping during COVID. I've heard there is a lot of Zillow shopping over the past 2 years. And that's using advanced mathematics. The problem is that most of these AVMs still use the sales comparable approach, which is mired in using this devalued data set. And ultimately what that does is it lowers values and it sequesters wealth from homeowners in communities of color. So what Just Value does is not find what should be the market value of a home, which is often what, that's what Zillow is finding for you, but it's telling you what the unbiased value of a home would be. And if we create market supports to realize that value, then homeowners over time will be able to access the full equity of their homes. And ultimately, our vision is that they'll be able to transact at that value, to be able to capture the full value of their home.
That's great. Thanks, Charu. And Caren, you've heard a lot of different angles on this issue about mechanisms for expanding credit. Can you tell us why the center chose the path it chose to address this issue? Tell us more about the goals of your project and how it's going so far.
Thank you, Brian. So one of the things that we've understood and that we've heard clearly from the other panelists is that we have to focus on credit and accessibility to credit. And how do we do that? How do we do it in an authentic way? And how do we do it in a way that absolutely captures what we're seeing, not just with the market, with what Zillow is saying? Thank you for mentioning that, Charu. That was a really great point. But also how we value credit and how we extend that path to homeownership. And for underwriting for good, we're taking the practices that we've already seen and put in place. We've seen it with SONYMA. We've seen it with many other smaller programs, and we've seen it with our own CDFI, Sustainable Neighborhoods. And we understand how to approach it programmatically, and we're trying to turn that into a system that gathers that data in a way that is automated, but we also have to be careful of saying that because fast data isn't necessarily the answer. I think it goes back to Charu's point, which is we have to examine the formula that we're also using to value that.
Yeah, absolutely. Thanks. I want to dig into these really interesting data and modeling questions. But first, I want to ask Darrelle what the reception has been like from your partner lenders and other folks about the innovations, the approaches you're starting to take. What's starting to be the impact in the industry, and then beyond that, are the products getting to borrowers? How is that going?
So, I think lenders have been slower to embrace the mission of the program. We sort of aimed it at households of color and those households that had been underserved. But the program has been available, across to anyone, and they have utilized it, but not as much as we'd like. I think our other partners, besides the lenders, our housing counselors and other partners, I think, there's something to be said for muscle memory, and they're used to applying standard credit models, right? And so when there's an opportunity to apply this broader credit model, they have not always taken advantage of it when they should have, right? And so we're countering that with continued messaging, continued education, so that, we create new muscle memory. I think where it's been successful is causing our lending partners to reevaluate their own credit models, right? If SONYMA has been willing to take the risk and change guidelines and what we evaluate, where we have had success is that our lending partners have also broadened their own products beyond the SONYMA products available to first-time home buyers. And our mortgage insurance partners have also broadened their credit model. And so I think the impact is more subtle, but in some ways broader than the SONYMA Give Us Credit mortgage product could be, right? It hasn't turned out how we'd like, or how we anticipated rather, but there has been some really good ways that it has impacted home buyers across the board everywhere. But we continue to encourage our partners, our lending partners, our housing counseling partners to learn this new thing and add it to their own arsenal in terms of how they approach mortgage finance and getting it out to communities.
That's great. So now we'll go back to the kind of data modeling question, and I guess this is a question both for Caren and Charu. How do you know that what you're doing is an improvement? How do you know you're doing a good job at what you're trying to do?
Rather a broad question. I think what we measure, when we measure success, what we absolutely have to do is look at where we're getting our model and our data. We have to be extremely careful with how we're gathering it, if we can trust it, and really how we're using it. And I think the measure of success has to be, is it being accepted by the lender or by, the housing counselor or the person at the end? And the next part of that has to be, is this on the right path? Meaning, is this pushing us where we need to be? I think one of the things that we saw with Underwriting for Good, and Charu, I wonder if you saw it with Just Value as well, is we can have all the data in the world, but if it reflects the current traditional borrower sets that are extremely white, then we still haven't gotten to the point that we need. So again, I think we have to be a bit careful about where we're getting that data, how quickly we're intaking it and trusting it, and really how we're applying it. And Charu, I turn it over to you because I know you were going to answer as well.
Well, Brian, that really gets to the heart of the question with all of these sort of algorithmic solutions that are becoming more prominent today in the lending industry and the valuation industry. And there's a few different ways to interpret that question. So I think you were vague on purpose here. The first is accuracy. And I guess that maybe this is a bit Pollyannish, but I don't believe any models are accurate. I think that all models are designed to be directionally correct and are more driven by risk appetite than about complete accuracy. And that's true about appraisals and underwriting models throughout the industry, whether they're commercial, conventional, or non-traditional, like we might be working on. So I think that's just a reality that we need to accept, that math is not definitively correct. Even the traditional approaches that we use have a margin of error. So I think part of Just Value's platform is that we should have a lot more transparency into algorithms, period. That we should have a set of best practices that give users access to understanding as to how accurate those models are, and have transparency around equity. I think the second way to interpret it is in terms of just sort of how Caren talked about it. How successfully are you reaching populations that have been missed due to a traditional approach that is designed to meet the majority or the previous majority of commercial lending and commercial valuation, traditionally the white middle class and upper class. And Caren, I probably have to disagree with you here in terms of measuring success by whether it is accepted by lenders, for instance, because I think that is really the ultimate goal. It's what I call market correction, but there's so many you need to take before the approaches you and I are working on become adopted in the mainstream. And that's why I think of even the work Darrelle and Derek are doing as part of a system of innovation. And we really do need this ecosystem of other players, other types of lenders to prove out how risky these approaches are. Because until, as Darrelle has pointed out, there's some approaches that may seem risky from a traditional perspective, but when piloted and proven, they actually are much less risky than previously thought. So I really think, for me, success is about accessing this ecosystem of innovators who want to support alternative approaches and frankly contribute their data and their platforms to investigating those approaches.
That's fantastic, and I love that direction. Let's go to you, Derek. I'd love to hear what kind of impact you'd like your product and the wider CDFI to have. Are you looking, just within a tight circle, like make these specific customers credit worthy, or make them bring them to the door of homeownership? Or are you looking to essentially innovate your way out of business by spreading this vision and this approach to the wider lending community? Where are you looking for impact? How far out do you want to go?
I mean, to your point, I wish that I didn't need to be in business, right? The point of us is to cannibalize ourselves, right? So for us, we hope it's hugely successful. In year one, we're doing a $20 million capital raise for it. I see Caren shaking her head. We're part of a homeownership collaborative with LISC and the Center for New York City Neighborhoods. And so the ultimate success of our program depends in large part to this open access fund. In year one, we're looking at 20 million, but we hope to grow that each year. I'll be meeting with representatives from New York City and New York State We got a $1 million grant for a loan loss reserve. When I talked about the need to take on more risk, that's exactly what we're doing. Right? It's going to be a little bit technical, but stay with me. Typically, loan loss reserves are about 10 to 1. Right? If I want to raise $10 million, I need $1 million. We know this product is more risky to our banking partners, so we needed to increase our grant funds associated. So to raise 20 million, we need $3 million or so of grant funds. So as I mentioned, we got our first 1 million, but we're meeting with the city and the state to increase that because, again, changing nothing for a client, they have access to additional $222,000 of home prices. In New York City, which is the second highest cost home market in the US, that additional funds available for home ownership is critical for us to bridge the wealth gap and also put minorities on at least closer to equality in this market. Right? We all talked about the historical impacts of it, but without literal will to change, it's not going to happen, right? You know, a couple of years ago after George Floyd, we did see money invested by large corporations in this area. Now it's time for that money that was given to be spent on programs that really have an impact. If we are going to do the same thing, we're never going to change, right? If the banking community isn't going to adjust their underwriting guidelines, then we're going to stay in the same position, right? Now, for us, you asked me what I would love to see happen. If the banks don't change their underwriting guidelines, then we'll grow and take up the New York City market, right? If they do change the guidelines, then I put myself out of business, which is a good thing for me. So either way is a win.
That's great. Part of the hope for impact, I think, for all of you is on the end consumer on expanding that base and access to credit and all the things credit can do. But another level of impact could just be on who the decision makers are in this space and who's at the table. When you guys have conversations in the industry, when you pitch products, when you speak with other organizations, are those rooms looking different than they did when you first got into this business in this area? Are folks represented there, or communities represented that didn't used to be? Is that having an effect on the kinds of conversations you can have?
I'll start. I've literally been told that they don't see me as the face of the company, right? For a job in the past, the board literally said they don't see me as the face of the company. When I was in corporate, I was literally told, you're young and Black, you should be happy with how much money you make. I'm getting older, but I'm not 50 yet. So this isn't, in the 1950s. This is literally in the 2000s that these things are occurring. Right. And so when you ask, do I see people in a room that look like me? Most times the answer is no. Right. I'm hoping those things will change. And the big pushes typically come from the nonprofit space. And to be honest, we got limited power. Right. And so it's great when we get dollars from big organizations, but we also need the will and their push to make that change. And so if you aren't going to allow people like myself in a room to have these conversations, nothing is ever going to change. So from my perspective, I don't see it changing very much over the last 40 years that we've been in existence. And it needs to change. If it's not going to do it now, I don't know when it's going to occur.
What about for those of you more on the data side? Have you had a different experience or similar perspective?
Similar. And I'm very conscious of Derek, you saying that the idea that they don't see you as the face or the CEO is just mind-boggling, because you are. Like, I don't understand that. But more so, I see now and only now that we can begin to have the conversations of, okay, you're not going to solve it. You're not going to solve it. You're not going to solve it because you guys have been in business for years and years and you've still messed it up. What do we have to do as the smaller guys, as the nonprofits, as the interrupters? What do we have to do to get these conversations going? And I think they're starting to happen, but they're happening very slowly, which could be a good thing because we're careful, we check our work, we check our progress, but it's still very slow.
I think what's really changed is how much more of society believes these circumstances. So if I look back across my life as a child, I grew up Rodney King was really a watershed moment in my own life as a child, and many, many instances since then, and including in my professional life over the past 20 years, there has been just a lack of belief and understanding by the industry, by colleagues, that these are problems, that undervaluation is a problem, undercapitalization is a problem, that instead those have been pinned to the worthiness of buyers and borrowers. And what's really changed is belief. Thanks to a ton of research that has happened over the past decade that is being raised more often by facts that are being brought by organizations like Derek and Darrelle's and Caren's, that there is much more awareness within our society of systemic racism and bias within the real estate industry. And so what does that do? That makes a lot of these conversations much easier to have, because you're not proving the premise of your point, which is really where, until the past couple of years, most of my conversations were. It was really proving the premise that there's bias within our industry. I feel that I'm much more easily able to mount that, to sort of convince listeners of the existing problem. I think the next phase is really what we've talked about today, isolating risk and really understanding that parity is a social and economic good that will not only make sense for a business or an investor, but really improve communities overall. And looking back at the instability, societal instability we've had over the past several years, I'm hopeful that our economy can appreciate how important social stability is as well as an economic prospect.
And I'll jump in here and sort of build on what all the other panelists have said. Certainly, like Derek, I've been perhaps longer than Derek, I've been in finance and mortgage finance for over 25 years, and I was certainly never in any of the spaces that I occupy what would be considered the face of the company or representative of the company. But over time, I would say that what has become a change in the right direction is that, they weren't even aware of the problem before. Right? Being in that room, if I raised those issues, I would have gotten blank looks. Now, I think many more decision makers in those rooms are aware of the problem and open to discussions about the problem, maybe not for all the same motivations. Since joining SONYMA in New York State, that was a real transition for me. I had always worked in the private sector. And so the missions that our nonprofit partners and SONYMA had, that was never the focus of the rooms that I occupied before. But even today, within those same rooms of decision makers, they're much more open to the conversation. They are aware of these issues, and maybe not for the same reasons, even if that, that their motivation may be profit. They are willing to have conversations and to try changing things, if for no other reason than profit. But it is an easier conversation to have, right? I've always tried to have these conversations in those spaces in sensitive ways. But now I think there's a lot more engagement and a willingness and an openness. We have a long way to go, but I do think that we're slowly heading in the right direction.
Well, thank you. Thank you, all four of you, for sharing. So I think there's about 10 minutes left, and I want to make sure there's time for questions. I believe somebody from the center is kind of manning the questions. Here we go. Here they come. So for Charu, a question from the audience. Appraisal methodologies seem very opaque to both homeowners and other stakeholders. How can the work that you do make it simpler for lay people to understand, in addition to like a better outcome objectively?
That's a great question. And I think it's something that I need to think about or have been thinking about. I don't know that my methodology is any simpler, to be honest. I think the standard appraisal methodology is the simplest it will get. But because of its simplicity, the bias lives in its simplicity. So instead of making it maybe the approach more simple, I do hope to make the approach more transparent and to make it clear where parity lives or where equity lives within that model. So I do think that I agree with the questioner that the appraisal process, and the methodology can be very difficult to understand. And I think part of it is really building homeowner knowledge and acumen about appraisal. I know that many homeowners receive their appraisal and they may never even open that file unless there's a problem with the mortgage, with being able to borrow against the full value in that appraisal. So I think the first is just creating a little more awareness among homeowners. But really, for me, the focus is about introducing a lot more transparency. So if you, again, go to Zillow and you read their fine print, you can see that the value that they offer, that's within a range. That's a range of value that they offer. But they only sort of highlight one value. And so it's really making the fine print bold print. So for instance, one discussion in the industry right now is to offer a range of value rather than a single value. That doesn't necessarily mean that our lending practices are going to change very quickly, but I think it is a way to educate the market, including the homeowner and a prospective buyer, that there is a range of value here and all of it is acceptable by the market. So I think that's a great question. And I think that it's a combination of more education as well as more transparency and metrics for homeowners to compare against.
Thanks, Charu. And actually on that note of industry adoption, we'll turn to a question for Darrelle. It says, how close are we to universal adoption by financial institutions of the reporting procedures that you've described? And maybe on a scale of 0 to 100, and maybe it's low, but yeah, where do you put us today? And yeah, maybe be optimistic. I don't know.
So I love the goal. I love the idea of universal adoption. In fact, I think I'm going to put that as a sign on my desk. We're a long way from that. We are a long way. We're headed in that direction, and some of the work that the panelists have mentioned, their own work, is going to get us closer to that. Things like the efforts that Caren is working on in creating a platform that can be shared easily, that would also get us closer. But I do think that SONYMA's program and getting greater adoption, not by individual lenders, but by all the supporting organizations like their mortgage insurance providers, right? So if we change policy for a mortgage insurance provider that serves hundreds of lenders, right? You know, that can be one step, but a really big step towards universal adoption. So by being persistent and strategic in getting various participants in the market to go in this direction, it's one of those things that I hope and I could foresee being not a slow evolution, but jumps, right? If we have platforms and software that this expansion is built into, right? That could be a jump, because if that platform serves many lenders, all of a sudden you have many lenders with that adoption. So I won't say on a scale of 1 to 100, that we're even at 50 or even 25, but we're headed in the right direction. And it does not necessarily mean that we're a long way from universal adoption, right? If we are strategic in how we seek to expand it. And these panelists and many other folks who are making these efforts, you know, we could be around the corner from universal adoption, but I know that we're not there today.
Thanks. Derek, we have a question for you from the audience. The perceptions and the, you know, the racism that you experience and that you shared with us, other than getting more loans out there, what's a housing organization to do about that? What's the role of a nonprofit in that space? Is it something that can be intentionally worked on by the nonprofit community, or is it kind of in the background, or a hoped for add-on effect? Do you think there's a direct role here to address those kinds of attitudes?
So is there a role in the nonprofit space? The answer is yes. Like there aren't only nonprofit housing organizations, right? There's a bunch of nonprofits, and some of them work specifically on this. You have someone like 110 whose job is to ensure that African Americans get quality jobs. So there are a bunch of nonprofits that do things in this space. So yes, there's a role for nonprofits to play. Specifically for me, the role I attempt to play is to be unapologetically Black, right? So oftentimes we feel like we have to be embarrassed to talk about the issues that Black people face and stuff, and no other community seems to be embarrassed when they have these conversations. We have to stop feeling like we need to mute ourselves for the things that happen to occur to us if we're going to have real change. So for myself, I just try to be a leader in my community. Obviously, as the CEO of a organization that provide mortgages right now. Again, the vast majority of our customer base, over 80%, identify as minority. So we provide those benefits there. But more importantly, literally, I left the corporate space to come to the nonprofit space so I could provide these benefits. And so when I talk about the need for the will for change, it's not just money. People have to be willing to stand up and make significant changes. Obviously, it's easy for me. I'm African-American male. I have African-American kids and I want their life to be better. I have to make those sacrifices. But if we are in this space and we say that this is what we want to do, everyone will have to be willing to make some sacrifice.
Got it. Thanks. Caren, maybe I'll ask the last question of you, just a couple of minutes to go, give you a chance to make your pitch or ask for help or ask for participants or friends or partners. What do you need from the listeners to support your program at the center?
Oh, Brian, what have you done? I directly want to work with everyone. Darrelle, I absolutely want to understand Give Us Credit more. And it's funny enough, it's the only program that currently exists right now in Underwriting for Good. We understood that just based on the criteria and the rules and the guidelines, it was one of the most promising that we saw in incorporating, looking at alternative credit and really bringing it to how do we make this easier for the Black and brown home buyer. And Derek, I know that we're working together, but we should work together directly, like cut everybody else out, like it's fine, and make it easy as possible. Just make it as easy as possible in understanding like how these programs can be pushed and massaged and really start making it not just the exception, but the norm. And Charu, we have to talk about the evaluation. That part is going to be super, super important in the appraisal process, but if and when we start any sort of refinance process, that would go with Underwriting for Good. So thanks, Brian.
Well, great. Glad. Well, I want to thank the four of you. Thank the center. I think it's a great topic. We've only obviously scratched the surface on many of these issues today. Yeah, just really appreciate being part of this. Thank you all for joining us this afternoon.
Thank you.
Thank you.
Thank you.
Hello again, all. Thank you to our panelists for a deeper look into the challenges when it comes to credit and amazing tools and resources that are being developed to combat these issues. Thank you so much for joining us today. We will see you tomorrow to kick off another day of exciting and insightful panels. A big heads up that the summit will be starting at 1 p.m. tomorrow. We look forward to seeing you soon. Have a good evening.